Awesome. Thank you, Mariah. Thanks for having me. Let me get my screen shared here and get us kicked off. Everybody can see my screen, I hope. All right.
Looks good.
So first and foremost, I have to do my legal disclaimer for everybody. The information provided in my presentation does not and is not intended to constitute legal advice. Instead, all information, content, materials available in my presentation are for general information purposes only. Information in this presentation may not constitute the most up-to-date legal or other information, and it contains links to third-party websites. Such links are only for the convenience of you, the student, and LendingProf does not recommend or endorse the contents of that site. So let's jump in. So we're going to actually talk about credit today. So one of the things that we're going to do is we're going to go over just some general information to kind of kick us off so that we all have the same understanding of what and why credit is important. How do we build our credit? How are those scores actually calculated? Then we're going to go into how we can improve the scores, and then how to keep our credit card usage low during a flip, and a couple of other things I've thrown in there as well that'll kind of help us out. So why is credit important to us? So good credit actually helps us make it easier for us to purchase homes, obviously, easier to rent apartments, easier to get any other type of a loan like a car, credit cards. It'll actually save us money in the long run because we get lower interest rate. We get better credit terms when we have better credit scores. We have a better reputation. We can gain more perks and rewards. Better credit gives us cheaper insurance rates as well. And it helps us just in general be more prepared for the future. But in terms of being a real estate investor, we get better down payment options as real estate investors when we have higher credit scores. So the lower our credit scores, the worse our down payment options would actually be. So our poor credit actually will end up costing us more in the long run because it makes it harder for people to rent apartments, harder to get insurance. It's hard to get loans. We get a lot less better credit terms, which is higher interest, and it costs us in the end a lot more money. It declines our reputation. We don't typically get those perks and rewards on those credit cards. And then we get higher down payment options as real estate investors. So our credit score, as you all know, is really important when we want to either get started in real estate investment or as we continue being real estate investors. So how do we actually build credit? You know, tips for building credit. I get asked this question a lot from people in different classes that I teach. But we have to be able to use credit responsibly. We have to keep that credit utilization low. We have to be able to make our payments on time. We have to establish a credit history for ourselves as individuals, but also we seem to forget as we start businesses that we need to start establishing a credit history in the business name as well, so that it's not just me, the individual, but it's also the business that's going to establish credit also. And then we actually have to monitor our credit report as we go through life because errors occur and we have an opportunity to fix those errors. But if we're not monitoring that credit report, we'll never know. So how do we establish credit to start with? I always recommend people that when we're really young, if we're fortunate enough that our parents help us get started, they might get a secured credit card for their teenager in the last couple of years of high school, so that when they are getting out and starting to adult, then they've already established a credit score. But ultimately, if we have no credit whatsoever, or we have poor credit today, we need to consider doing a secured credit card. When we do a secured credit card, what that means is that we're locking in a savings amount. So let's say I want a $500 limit on a credit card. So then I'm going to go to my bank or my credit union, and I'm going to ask for a secured credit card. Some of the questions I'm going to ask them is, you know, what's the minimum amount I can get? Because you don't want to go out there if you don't have credit and never used it before. You don't want a $10,000 limit. They're not going to give it to you. But you might be able to do like a $500 limit or $250 limit where you take that cash, you have them freeze it in a savings account. So you're earning dividends or interest on that amount, but then you're getting the credit card. So then that way there's no risk to the financial institution. However, be sure if you do a secured credit card, they're going to report it to the credit bureaus. So a lot of credit card companies, like the really large ones, some of the Capital Ones, Chase, things like that, they're not going to report secured credit cards. They'll give you the secured credit card, but they don't report it to the credit bureaus. But what they'll do is they'll make you retain that card for about a year, release the security back to you, and then they'll start reporting. So make sure that when you do that, you're always getting it reported, even though it's secured, to a credit bureau. And typically your local bank or your credit union will definitely report those. Use credit builder loans. Credit builder loans are really neat loans. Those are prevalent at credit unions. So if you belong to a local credit union, then a lot of those credit unions are going to have a credit builder loan. But by all means, ask your bank or wherever you're banking at today if they have any type of a credit builder loan for you to get so that you can start to establish credit. And you can always become an authorized user. This is where, usually we'll have teenagers and things like that. Maybe we'll add them to a parent's credit card so that they can start to build credit. And then obviously you can ask for co-signers. Co-signers is a little bit trickier because you might have to begin by getting a loan with a co-signer so that you're establishing the credit score. But if it were me, I would do these first three before I'd ever ask for a co-signer, especially number one and number two, where we consider a secured card and we do a credit builder loan. So then how are our scores actually calculated? So scores go from essentially a 350 up to a 900 credit score. And you can kind of see in this chart here that, we have really low scores. So anything realistically speaking that is a 640 or under is really no longer considered they're all poor scores, or, like if you're a 360 to 580, you're really bad. If you're 580 to 640, you're still bad, but then you're kind of mediocre between 640 and 700. And then it starts getting better and better the higher you get. So you can see you essentially today have to be over a 700 credit score to get the really good credit terms. So in terms of investors, real estate investing, because these are a different type of loans, especially these fix and flip loans. They're very different than your standard primary residence that you're going out as an individual and purchasing your primary residence. So the credit is looked at very differently when we're doing a business purpose or a fix and flip type of loan. And usually you've got to be 660 or above to really be able to do those types of loans. So if we have credit scores that are underneath that, we just need to work on those so that we can get it to a certain point. But you're going to get the best terms, the best down payments if you're over a 700 credit score. So score calculation, I get asked this a lot, is what really goes into that? Well, first of all, our score, it's just a 3-digit number. There's 3 credit bureaus, and it's an evaluation of your entire credit history from the time of whenever you get started, if it's when you're a teenager, throughout the rest of your life. So we're going to go through. So basically 35% of our credit score calculation is derived from payment history. And then 30% is amounts owed, 10 is new credit, 15 is the length of the credit history, and then 10% is the credit mix. So let's talk about payment history. So 35% of our score is derived from our payment history. Obviously, the easiest way and the fastest way to improve our credit score is to pay our bills on time. So the later payments you have and the more recently they occur, the more points you lose. So this is why payment history is so important. So let's cover that again. The later payments you have and the more recently they occur, the more points you lose. So a 60-day late payment a month ago hurts more than a 90-day late payment 5 years ago. So just kind of keep that in mind, that the sooner the more current they are, the more it's going to hurt. So amounts owed. That's 30% of our score is the amounts that we owe. So you lose points for being close to your maximum charge limit on any single credit card. You should limit the amount of debt you take on. And 30% of your score is going to be based on that. So if 30% of my credit score is based on the amount of debt that I owe, as a real estate investor, what's that look like? Are you putting repairs on credit cards and then racking up that credit card debt? So this is where we look at is when we're real estate investors and we're doing house flips, that credit and the amount you owe is going to ebb and flow over each individual month, right? So then when we have that ebb and flow, our score is going to constantly be fluctuating. Length of history. 15% of your score is going to be based on the length of your credit history. The longer the credit history, the higher the score. This is why mom and dad always have higher scores than, our kids. So we always start out at the 0. And as we go through our life, our score should progressively get a lot higher. And ultimately, we should get to our peak, which is 850 or above. One of the things that I see a lot of people do with where they affect their score so significantly, because this is 15% of our credit score calculation, is what they'll do is they work really hard to pay off all their debt. And when they get all that debt paid off, they want to close the cards so that they don't have the desire to use the cards any longer. And they close the wrong ones. Don't close your credit cards when you pay them off, unless you absolutely have to. The only time I would recommend you ever close them is, are they going to start charging you an annual fee for not using it? So again, it depends on what type of card that you have, but there are ways to avoid a lot of that stuff. But I recommend that if they call you up and they say, well, we're going to close the card because you don't use it. Okay, go out and buy gas one day and then go home and get online and pay for that gas instantaneously. It means, number one, you've used the card, met their requirement. And number two, you're not going to pay finance charge because you paid it off before the billing cycle was up. So there's certain ways that you can look at doing things like that so that you're not closing those items. And then you'll retain those cards. And then if you don't have the discipline, don't keep it in your wallet, maybe put it in a safe somewhere, your safety deposit box, or wherever you store your secure documents, so that it's not readily available for your use. New credit. This is where we kind of mess up sometimes too, is 10% of our scores based off of the new credit we obtain. So opening several new accounts in a short amount of time will cost you quite a few points. This is why anytime we go out and we buy a car or we purchase a home, we do any type of loan, lending, credit card, anything like that, our score is going to dive the next month, and then it'll eventually rebound. And it's because it's considered new credit. And then all inquiries within a set period will count as one group together versus many individual if it's the same credit applied for. So we're going to talk a little bit more about this in some further slides, because I think this is one of the questions I get asked the most, and which is interesting. And you'll find it interesting through the class here as to what you're going to find out and how much that really impacts your score or doesn't impact your score. But ultimately, with new credit, I see a lot of people get a lot of credit cards. And what they'll do is they'll go out and they'll find those 0% promo rate cards, and they'll want to transfer a balance over onto the 0% where they're going to get 0% for maybe 6 months, 12 months. And then they keep rolling it so that they think they're getting a really good deal at 0%, right? No, you don't ever want to be doing that, because the more cards you open, it's damaging you. Plus credit utilization. If you don't close the prior card, and again, you have to be really careful when you're doing this. So it's important to just really understand how all of this works, so that you can strategically plan how you do things in your budget and for your finances. So types of credit is 10% of your score as well. And this is different types of credit, such as installment loans like buying a car, home loans, which are mortgages, revolving, which are your credit cards, home equity line of credits, installments. So we want to have a varying type of credit. I see a lot of elderly people pay off their home, pay off, our goal is to be not owe any debt when we get older and we're ready to retire. But keep in mind, when you do that and you no longer have a house payment, you no longer have a car payment, and you have no credit card balances, or maybe you've closed your credit cards and you only function on cash, you're going to have your credit score is going all the way back down. Then all of a sudden you find yourself needing a new car. Or maybe you want to downsize your home and buy another one, and all of a sudden you don't have good credit anymore. Therefore, you're no longer getting that really good credit terms because now you're back to almost day one. So I see a lot of people that, we work really hard throughout our lifetimes to do that, but we just need to be careful and find a balance so that we retain our credit score. Report copies. You can get a copy of your credit report from each credit bureau. I've listed them here: Equifax, Experian, and TransUnion. The only place you can get a free copy is annualcreditreport.com. So you want to make a note of that. Now, you got to go through all the rigmarole on their site to not have to pay for all their extra services that they offer, but you will get to where you can download a free copy of your report. I don't recommend. You're entitled to one free copy from each bureau per year as an individual consumer. One free copy per bureau each year. So what I might want to do is maybe in April, I'll order from Equifax. Spread it out over a 12-month period of time so that you're always kind of checking. Don't go out there and request a copy of your credit report and get all three bureaus all at once, because now you don't get any more free ones throughout the year. And if we're monitoring our credit for errors, we want to monitor it throughout the year. So kind of keep that in mind. So reviewing your credit report. What are the things that you should be reviewing on your credit report? You should review your credit report annually to ensure everything on there is accurate. Dispute any of the errors that you see with each individual credit report agency. You don't do it online either. We'll want to be doing this in writing. That's a whole other class. But ultimately, you want to be able to dispute any errors that you have, and you have to dispute them at each individual credit bureau. So improving your score. Check your report for errors. That's very, very important. Dispute any of those errors with each credit bureau. Pay your bills on time, obviously. That's the largest factor that impacts your score, is your payment history. And then if you've missed payments, you've got to get current and then stay current. You have to reduce the amount of debt you owe. So let's talk about this when we talk about credit cards, because this is where I see most people's scores are low because of the fact that it's not that they've got late payments, it's that their credit utilization is too high. What that means is you've got credit card balances. So if I have $1,000 limit, I shouldn't have any greater than 30% of that limit charged on that credit card. But I see a lot of people max out their credit cards. And so once you go over that 30% utilization on that credit card limit, it's going to start counting against you a little bit, not for you. So it's kind of keeping in mind and maybe making it, if you've got multiple cards, then, create yourself a little spreadsheet, write down what is the interest rate on all of your cards? Is there an annual payment fee? I mean, start tracking, what all is out there for those individual cards. What's your balance? What's your limit? Because then you're constantly ensuring that you're staying at that 30% utilization or less. Because once you start going over that, especially once you're over 50%, your credit card is no longer working for you, it's working against you. Keep balances low on credit cards, obviously. Pay off debt. Don't simply move it around. This is where we talked about, don't go out and get the 0% cards or 0% financing and all of that stuff. Even going to like a furniture store, for example, if you go to a furniture store and, they always have those promos where they do 6 months, 0 interest, 12 months, no interest. Well, what happens is people don't, when they go and get there, those are good things to take advantage of if you understand how they work. Because I would want to take whatever cost I spent in my furniture, and if it's a 6 months interest free, I have to have it paid in full at the end of the 6 months. Otherwise, they're going to back charge me the finance charge from all the way back to the beginning. And people don't realize that, and that's hundreds of dollars, sometimes thousands, depending on what their interest rate is. So just keep that in mind. How long does it take? So this was a frequently asked question that I get asked quite a bit. Is, in general, significant credit score improvements might be noticeable within 6 months to a year, especially if you're actively working to address negative factors and improve positive ones. I always tell people it can take us a day to ruin our credit, but it could take us years to improve and to rebound that. So keep in mind, it's not going to be something that's instantaneous. It is going to take a little bit of time. And I usually tell people 6 months to a year. Achieving a substantial improvement can take even longer than that. It just depends on really what you're trying to do. But obviously timely payments, as long as you're making timely payments, it'll take a few months. Credit utilization, that's your quickest impact, is being able to pay that balance down below that 30% mark. So that could take anywhere from a month to a few months to a year. It just depends on how much extra cash you have. And the negative information only diminishes over time. So because that negative information or derogatory credit is what we call it, 7 years. Bankruptcies stay on your credit report for 10. So keep in mind that derogatory credit, collections, judgments, all those types of things, all of that's going to stay on your credit report for 7 years before it completely drops off. So just because I pay a collection item doesn't mean it's no longer on my report. It's just going to update that it's been paid in full and that you don't owe it any longer. So the ever dreaded credit inquiry. How much? So how much does the credit inquiry impact my credit score? So the impact of a hard credit inquiry on your credit score is generally relatively small, typically resulting in a decrease of about 5 to 10 points. So I get a lot of people call, well, don't pull my credit, don't pull my credit, you're going to ding my credit. Well, let's talk about that for a minute. It depends on what it is you're doing. So if we're doing mortgages, for example, because obviously that's what I do, and I get a lot of those types of questions. So then it depends. Are you shopping all around the same time period? Because if I'm shopping within a 14-day time period, whether it's for car, whether it's for other types of loans, mortgages, things like that, as long as I keep it within a certain time period, I'll only get 1 ding instead of multiple if I'm shopping around. But ultimately, it's gonna affect your score only a few points. That's not the issue with the score and your score going down. The issue with the credit scores is credit utilization or payment history. That's 35 and 30%. And then the 15% is the types of credit that you have. So keep that in mind, that it's not really the inquiry you worry about so much. But then again, if I'm borderline as an investor and let's say I'm a 665 and I went out and had a bunch of credit inquiries, then my score may drop down a little bit. So, that's where it would be the major issue for people, but ultimately in the end, it'll rebound faster than anything else. So again, the actual impact can vary depending on your individual credit profile and the scoring model being used and your overall credit history. Keep in mind that there are hundreds of scoring models that can be used with each credit bureau. For example, when you're doing mortgages, we're doing what we call a tri-merge credit pool, which we're going to pull an all-inclusive credit report from each bureau, which is why we call them tri-merges. When you go and buy a car loan, you're actually going to get a car type of credit report pulled where that credit score is going to be weighted heavier on how you pay your car payments. When you go and you get credit cards, they're doing a different type of credit pull too, because they're going to pull a credit report that is going to be based on, and they usually only pull from one bureau, so it's whoever they do still use, but then they're going to pull a credit bureau that's going to be weighted towards revolving debt payment. So it's very different depending on the type of debt or type of loan that you're applying for. So key points for you to keep in mind is limited impact. While a hard inquiry does have a short-term negative effect, it's not a major factor in determining your credit score. Other factors, just like I said, the payment history and credit utilization, those are going to have a much higher impact. The time frame. This is where the impact of a hard inquiry is most pronounced within the first few months. After the inquiry is made, over time, the effect diminishes. Bunching of inquiries, multiple hard inquiries within the short period, such as when you're shopping, that we just talked about this, is going to be considered and lumped into a single inquiry from a scoring purposes. And a rate shopping window. Generally, credit scoring models group similar types of inquiries made within a specific window into a 14 to 45 day, so as a single. So keep that in mind. And then the long-term impact, while the immediate impact is small, having too many hard inquiries over a short period can suggest to lenders that you're seeking credit frequently because you're starting to have some issues and there's some budget tightening and things like that, and you're starting to struggle. So that's kind of why they look at those credit inquiries, because if you're getting a whole bunch of new stuff, you know, they're going to start looking at, well, why is this individual doing this? So all of that, there's just a lot of different things that creditors are going to look at depending on what it is you're actually trying to purchase. How to keep credit utilization low as a flipper. So when it comes to financing renovations for fix and flip projects, obtaining a line of credit can be a preferable option other than relying on your credit cards. So obviously when we do fix and flip loans, we purchase the property, we finance the flip portion of it for an end goal. So, but I know that it's easy to go over budget, especially in today's environment, because that's what you have to be looking at, is if we're struggling as a flipper, putting all of our additional costs on our credit cards, then what's going to happen to our credit score? It's going to tank, because my utilization is going to go up, because you're not going to be able to pay that utilization down until you sell that property. And then again, time is against us because it takes time for things to rebound. So I've also suggested here, establish credit in a business name versus solely using your own. Because when you start to establish credit in a business name, maybe you can get that line of credit through the business instead of as the individual. Otherwise, you can certainly get a line of credit against a primary home that you currently own as an investor, or if you own investment properties that you've retained and you've got some equity in them, then you could potentially get a line of credit on that property. But again, everything that we do when we initially do it is going to bring our scores down before they're going to rebound. So lower interest rates. So generally lines of credit tend to have lower interest rates compared to credit cards. So it's important to know what the rates on your credit cards are versus what a rate on a line of credit would be for you, because you could save quite a bit of money that way. They have higher credit limits than what you would have on a credit card potentially. So lines of credit, they typically, they can provide you with greater flexibility and purchasing power when it comes to financing, your additional renovation costs. So for example, if I have a lot of equity in my home, I might just do a home equity line of credit against my primary home. And then when I need to draw funds for additional repairs, if I'm going over budget, then I'd want to use that line of credit versus my credit cards. Flexible repayment options. The lines of credit often come with more flexible repayment terms compared to credit cards. So that's something to make sure that you look at if that's an option that you want to look at with a line of credit. You separate your personal and business expenses. So if you're going to get that line of credit specifically for your fix and flip projects, you can keep your personal and business expenses separate. That separation helps with accurate bookkeeping, tracking project related expenses, and maybe simplifying your tax filings. So something for you to consider as well. And then you get higher credit limits with responsible use and timely repayments. The lines of credit may offer the potential for higher credit limit increases over time. This increased credit capacity can be beneficial for future fix and flip projects and other investment opportunities for you. Just make sure you understand how that line of credit works. And then your steps for a strong financial foundation as a flipper is, I really kind of thought about this a little bit, is obviously you have to have your written budgets because you have to present all of that in order to get your loan. But as the more flips that you do, I think the more accurate your budgets can become. Create strategies for paying the bills off. Once you flip the house, how can I reduce my debt so that then I'm saving more, so that then I have to put less in the future on my credit cards. Obviously manage your credit cards and then watch your credit utilization. That's what's hurting you the most as a flipper, is most likely the credit utilization, and the fact that if you're constantly flipping, You're constantly buying, selling, buying, and selling. And what is that when we look at our score calculations? It's new credit. So then, keep in mind that it's always going to affect us. So credit scores, I was asked the other day by an individual, well, how do I stop my score from changing month over month? You can't. It's impossible. Because as we've seen here, we make payments on our debt every month, correct? So then that debt, that balance goes down, but then we turn around, we might charge something on a credit card. That balance is going to go up. So everything is going to be in ebb and flow. And if we're buying and selling properties, then that credit score is constantly going to be in ebb and flow as well. And then let's see, additional resources. You can always go out to myfico.com. There's all kinds of credit resources out there. You can go to mylendingprof.com website or consulting site. Consumerfinance.gov has a ton of information out there regarding credit as well. And then each of the individual bureaus, they usually have all kinds of information that you can download, or training webinars, all that different type of stuff that you can go in and look at as well. And they'll provide information about credit score, their models and things like that. So there's all kinds of things out there and places that you can go to get additional information on credit. And then if you want to download my mobile app, you can certainly, if you want to reach out to me outside of this, you can by scanning the QR code here. And then I'm going to go ahead and open up the Q&A. And if people have questions, I can answer some questions maybe.
Cool. Thanks so much, Holly. This has been super informative. I was writing down notes along the way. But yes, feel free if y'all want to go ahead and post your questions into Q&A, and we can answer there in chat, whichever works best for you. And then Holly, I know we have some questions as well that we get from investors. So if people are feeling shy, we can ask those. But it looks like we at least have one in the Q&A, if you can see that already.
We do. So the question here is, if you're trading your car to the dealership and it's still being financed and they agree to pay off the loan, and they take up to 90 days to pay off the loan, what can you do when the creditors call you about the loan? That's a difficult question to answer, because all you can do in that case is reach back out to the dealer. But that would be hard to believe from a financial institution perspective, because the dealer can't sell the car until they get the title. And they're not going to get the title to the car that you traded unless they pay off the financial institution. So it all depends on how that deal was structured on your purchase agreement. And so that I'd have to look at the paperwork specifically and understand, what was going on there. But from my years of experience in doing auto lending and working with car dealerships, I would find that interesting to not get the money, because they want the title, because they can't turn around and sell that vehicle unless they have that title. So they want that title, and they almost want a guarantee of that title being released from your financial institution, which holds the loan today. They almost want that instantaneously. And it just depends on the dealership size, where your loan's at, all of that stuff. So I think there's a lot of factors in there that would come into play, but that seems like an awful long time to me, that they're not getting the title to the vehicle. And but you can also work with your Department of Transportation and reach out to them, and they'll do an investigation. So, that's always an option. We've instigated some of those as a financial institution in my past. I've had to do that a couple of times. I won't say never, we never say never, but as soon as you get the state involved, or the, Department of Transportation involved, dealers will hop, skip, and jump real fast. So that might be something for you to consider, and your financial institution might be able to help you with that as well. If you pay your monthly credit card, can you pay extra money to pay off your debt sooner? Yes, you can pay the entire balance if you want to. You can do that on any type of loan. Just make sure that on your mortgages and things like that, that you don't have prepayment penalties. If you pay off the balance in full, that would be the only caution. So a lot of these investor type loans that we do, they have prepayment penalties, or like commercial type loans, business purpose loans, prepayment penalties. But keep in mind, just depends on how you structured that loan in the very beginning, and what those prepayment penalties would be. But usually you don't have any type of a prepayment penalty on car loans, typical installment loans, your primary normal, primary, secondary home loans don't have prepayment penalties, and then credit cards don't typically either. You can pay typically however much on them that you want. I highly recommend you pay more than the minimum payment, because you can see on your credit card statements now, because this was a requirement with the FTC, that the credit cards actually have to put on your credit card statements that how long it'll take you paying the minimum payment to pay it off. Have you ever looked at that on your card statements? Take a gander and see what it looks like, because you'll be shocked. I mean, it may come up and tell you it'll take you, 35 years to pay off this $500 credit card, or, depending on what it is. So pay attention to that, because the longer you carry a balance, the more it's going to cost you over time. Because keep in mind, our goal is for it to cost us the least amount in the end. And we want to be able to keep that utilization low also. And then I'm going to go ahead. Hopefully people had a chance to do that. So then this is a book on unlocking the secrets to real estate investing that I wrote, and you can find that out on Amazon. And then just my contact information here for you. Can you talk about rapid repair? My mortgage lender did that when I bought my first house. Credit was in bad shape, and over a few month period, I paid down debt and it jumped about 30 points. Rapid credit repair. So we kind of mentioned that in the screens previously, that I get asked a lot about people using credit repair companies. So, they're not bad things to use. It depends on what it costs you. But okay, what did a credit repair company do that jumped your score only 30 points in a couple of months? Because that's stuff that you can do on your own and not have to pay for. It's just understanding how credit works and how we should pay those bills and structure that debt payment. But again, there, in my mind, and this is the Holly Luca personal opinion, credit repair, the fastest way you're going to repair your credit is that credit utilization, which we went over in that previous screen. Because if you can pay it down instantaneously, that's going to have your largest impact and your fastest impact. Otherwise, everything else you do is going to be time. So it could be anywhere from a couple of months, but it depends on how much cash do you have readily available to be able to pay that debt down or take care of whatever that is on that credit situation. So again, I don't say that credit repair companies are bad, but I believe we as consumers need to know what affects all of that, because you can fix it all on your own and not pay anybody to do it. And then you're keeping that extra cash in your pocket and using it to pay down your debt load. But again, some people don't want to do all. It's overwhelming. If we're in trouble with credit and debt, our debt load, it's really overwhelming sometimes to, where do I start? How do I begin? And so it's really just being able to talk with the right person sometimes to help get you at least a starting point in being able to do that and go through that. So there's some other, if you find my book on Amazon, for example, I've written a series of books also called Mastering. We'll just call it the Mastering Your Money series, if you will. And there's 4 books in that series. There's Mastering Your Credit, which is going to go over a lot of the things that we've covered here in this presentation and more. Then the next one is going to be your Mastering Your Money, which is a budgeting. So it's going to go over why we should budget, how do we get budgeted, what should our budget look like? And then we have Mastering Your Debt next, which is going to be, how do I pay my debt? What if I'm in trouble? How do I clean up? So you're going to see a lot of stuff in that workbook that is going to talk to you about how can you do all of this on your own. And then the final one is Mastering Your Home, which obviously is a really good workbook for first-time home buyers. It just kind of goes over a lot of the terminology and things like that. So there's a lot of different things in that series that you can work through just on your own and be able to read through it, or use the worksheets that are out there in that. But ultimately, it all depends on, do you want to do it or do you want to pay somebody to do it? And that's really what rapid repair is you're just paying somebody else to handle all that for you. And it just depends on what are they doing specifically versus what it's going to cost you. Because there really is no extremely fast way to improve your credit. It all depends on how much money do you have to take care of whatever is out there. Next question. If I had several credit cards, but only have a balance on one of them, but the balance is over 30% of the limit, would it be better for my score to distribute the balance across my other cards if doing so results in none of the cards exceeding 30%? Yes. Or paying down ultimately that balance under the 30%, but then no, once you get it there, don't use that card, now grab the other card or something like that. So yes, utilization is key. Now the other cards, they're not counting against you, they're helping you because they're at a zero balance. So the question here would be, what is the limit versus what the balance is, and how much can you afford to pay down in what period of time? Because keep in mind, if you're not going out tomorrow and buying something, making a major purchase, don't be moving your money around like that. Just work on getting that paid down because you have some time. So keep that in mind, is that if I go out today and I buy a house, because if I buy a house today, for example, my score is going to dip 100 points right off the bat, as soon as that mortgage closes. So I don't want to go out and buy a new car then, do I? Because my score just came down. I want to wait for that score to rebound back up over the next few months, then go out. Or if I go out and buy a car, if I go out and buy a new car today, my score is probably going to tank 50 points. I don't want to go out and buy a house then, do I? I want to wait. So again, everything that we do is going to take a little bit of time for things to rebound. What's the best way to have your credit company report to Duns and Bradstreet business profile? Just depends on whether or not they will. It's a question that you would have to ask them if they will report to that. If they won't, then it's finding the credit company that will report to the business profile. And, that's hard to say. Those are just questions. This goes back to even, any credit you get, whether it's personal or business, it's making sure it's reportable and that it's reported, because a lot of really small, like savings and loans from the past or things like that, they used to never report. Even if you had a mortgage with them, they never reported it. And car loans, you always want to ask that question, no matter what you're doing. But again, it would just depend on whether or not they will. Let's see. It's possible that you could repair it in less than 6 months. It just depends on what your individual situation is. So in general speaking terms, when I say 6 months to a year, generally speaking, that's usually what it's typically going to take people. It depends on what all is out on your credit that you have to repair and how much disposable income do you have to put towards that. So again, it's each individual. I mean, I have seen, usually within 2 months, I have seen and I have worked with individuals repair their credit scores jump about 30 points normally, anywhere from 30 to 50 points, and then they're able to do and purchase whatever they want to do within a couple of months. But then again, they can still keep working on the other things as they move forward. So it just depends on your individual situation. Not closing old credit cards. So keep in mind 10% of our credit score is derived from our credit history. And when you look at our credit history goes all the way back to day one when we first established credit. So if that was when I was 17 years old, and let's say mom and dad got me a secured credit card at 17, I don't ever want to close that credit card. because that's going to be my oldest credit card. And so it's going to give me the most points, if you will, versus the new credit cards. This is where going out and getting new credit cards over and over and over again is not a good thing. But we don't learn that as we grow up, and we're not learning that in school. We're not learning that in college. And a lot of times we're learning by trial and error as we, make our own credit mistakes over our lifetime. And so ultimately, the older the cards are, you want to keep those. So if you went out, let's say you have 10 credit cards. I've seen this. So let's say you've got 10 credit cards and 5 of them are new and 5 of them aren't. So if I had 5 new cards in the last year and I paid them all off, it would be my recommendation that you close all those cards, because I'd keep my 5 older cards and then I'd figure out the ones that I really want to use or are the best credit card options for me to use. I usually recommend you don't need more than 3 credit cards. And so typically I'll recommend 3 because that's usually what's going to help you get the strongest credit score, is because you're going to have a house loan, a car loan, maybe an installment loan, and then, a few credit cards. So I always recommend that people that I work with get a credit card from their financial institution, whether that's a credit union or a bank, doesn't matter, but you get one from there. And whether it's a reward or not, all depends on what programs they have and options they have. And then maybe if you have a store card or some other rewards that you're interested in, then you get that one. But just make sure that you understand and you know how all of the interest works, and the cards, whether they have annual fees, different things like that, over limit fees, all of those things kind of come into play. Are they a fixed interest or an adjustable? Most of them today are adjustable interest. So as the market, as the feds change that Fed fund rate, you're seeing your credit card rates increase typically. It just depends on how that financial institution does their cards. But great question. I missed the last part of that question. I think about 0% financing. Is there a way to go back to that, Mariah?
Yes, it's in the archived. It's also in the chat as well. So it's talking about the 0% credit cards.
Yes.
Yeah. So if they can hurt, let's see, you were noting that they can hurt one credit if used, or if it's used properly and paid before the 0% interest time frame expired.
Okay. You'd have to do all those calculations. So I'm going to say my answer to this is really no. Yes, you're not paying finance charge. You're doing it if you paid off in the 0% time period. So yes to that question. But offsetting, well, whether it offsets it or not, it's still going to bring your credit score down continually if you're going to continually open and transfer cards. Do you understand what I'm saying? Because remember that new credit, that's 10% of our credit score. And so every time you go out and you get a new 0% credit card, it's going to ding your credit, and then your balance transferring. And so the more you do that, then you end up with all these credit cards out there. And this goes back to also where when you're going to have all those inquiries on your credit report too. And that lenders are going to be looking at that because they're going to see you opening all these cards all the time. And then they're going to start questioning, why are we doing that? Did I answer everybody's questions so far? Did I miss any in the chat? Let me open up the chat here.
I think we're all up to date. So if anybody else has any further questions, investor specific questions, flipper specific, feel free to post those. And obviously I highly encourage you to reach out to Holly. She's graciously provided her information. So, when that's an option, always go ahead and reach out to Holly as well. Looks like last questions coming into the chat, and then we'll wrap it up. Holly, if you, or sorry, coming into Q&A, if you want to see that one coming in.
So in answer to your question, yes, if you close that Amex credit card and you've had it for 15 years, it's gonna hurt your score. My question to you would be, are you planning on making a purchase soon? A large purchase that, or where is your credit score at? Is it currently an 850? And if you close it, it's gonna drop you 50 points? No big deal. $300 is a big fee. But now my question is, are you charged the annual fee? If you're charged the annual fee, is it just that all the time, or do you not get charged it if you use the card? Because that's really, my question on some of these. So a lot of these credit card companies, because, and this happened during COVID, a lot of people had extra money, so they started paying off all their credit cards. And so then they're not carrying balances on their credit cards. And so now you have a maintenance fee that's charged to the financial institution that carries that card. And it's not as cheap as what you think it is. And so it's probably costing them anywhere from $50 to $100 just to maintain your credit card on an annual basis. And if you're not using it and they're not earning the interest to cover the fee, then that's why a lot of them started to implement annual fees just to try to get people to either close them or use them. But since it's a flat fee, you're going to have to decide, is it worth it? Because what's the rate on it? And is it worth your score dipping down a little bit? Because your score will rebound, but do you have another credit card that you've had just as long? Because
that's
that,
yeah.
I always ask people is, well, what's your plans in the near future? If you don't have plans to make any large purchase like a home or a new house to flip or a car, then is it okay for your score to dip down a little bit? Probably, at an 800, yes, I would say you've got room as long as you're not going below the 750. But again, it all depends on what it is you're planning on doing in the next couple of months. And then what other cards do you have out there and how long have you had them?
Awesome. Great food for thought. Thank you so much, Holly. This has been super informative. Really appreciate it. It looks like, we have one, let's say one final question, and then we'll wrap it for the day. And then we'll have folks reach out to you directly. So this last question from Mark, and then we'll wrap.
Let's see. So I have a Capital One with a $600 balance that I never use. So it's a 600 limit or a 600 balance? And it's a monthly $8 payment requirement. My oldest credit card I have on file, but I'm planning to purchase a property. You probably, if it's your oldest card, you probably want to keep that card. You're young, and if you have 7 cards, I'd look at which ones are your newest ones and get rid of those. But I'm not understanding your monthly $8 payment requirement. So essentially, if you don't carry a balance, they're going to charge you $8. Is that what I'm understanding? Or your minimum payment's $8 every month? Limit. Okay. All right. So if you charge on that card, are you still charged an additional $8? Or you just make whatever your payment is? All depends on how the card works, because if it's just a minimum payment that you're paying, then use that card, pay it off every month, and then you've met their requirement. But if they're charging you $8 every month no matter what, then my question is, how long have you had that card versus some of these other cards that you have? And this goes back to, so $8 no matter what, that's a pricey card. when you look at what the interest rate is on top of that. So this is why, I tell people, you really have to have a budget, and even when I talk with investors in general, this is the number one question I get asked a lot is, I want to get started in real estate investing. How do I do that? And that was the purpose of the book that I wrote, is that I get a lot of people that want to become a real estate investor, but they don't know how to get started. And it really starts with a plan. But we also have to have a budget, because part of our plan is, where are you getting the money for the large down payment? Because when we become investors, our down payment on investment property can be anywhere from 10 to 30% requirement. It depends on, are you a first-time investor or not? Where's your credit score at? What type of loan are you trying to do? So it takes a significant amount of money to get involved in real estate investing, because there's different ways you can come up with that money and be creative to come up with that money. But ultimately, you have to cover the down payment and all the closing costs. And the closing costs are going to be much higher on investment properties than they are on our primary homes. So what I find a lot is, when I start asking questions, individuals that haven't really thought about all of those different types of things, because we really don't know where to get started. But I would create that table or that spreadsheet, just get a Google, use Google Sheets, Excel, whatever you like to use, and list out all your credit cards. And so you want to list out the company, you want to list out, well, when are your payments due, obviously, how much, what's the minimum payment requirements, what's your interest rate, what's your limit versus your balance, so that you know where you're at from that 30% utilization amount, and any fees involved. And then when did you obtain the card? How long you've had it, and maybe put them in an order, because then maybe that'll help you determine, Mark, which ones are better to close and which ones aren't. Because if they're charging you an $8 fee every month on a $600 limit, and you're not even carrying a balance, that's a lot. Multiply that times 12. That's a hefty annual fee for a card, especially if you're not using it. And so, but look at it, because it is going to, anytime we close our older cards, it is going to pull our scores down a little bit. But keep in mind that credit history, it's not the 35, payment history is 35% and utilization is 30. That's 65% of the score on those two things alone. So the other things aren't going to have as large of an impact. It'll have an impact, but just not as large. But great questions today. Awesome questions indeed.
Yeah, thank you all so much for being here. Like I said, please reach out to Holly if you have follow-up questions. If you haven't already downloaded the Backflip app, go ahead and do that for your next investment. And we look forward to seeing you again soon. We'll send a follow-up email with details. So in case you didn't get them, you can get them there, see the recording. And thank you all again so much. And Holly, thank you for sharing your expertise. Really appreciate it.
Thank you, everybody.
Thanks all.